Good morning, I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and welcome to the second of our webinars on the real dividend heroes and growth giants. Presenting today is Samantha Fitzpatrick of Murray International, a globally focused equity income trust designed to generate a high yield and growing dividend while also delivering long-term capital growth. To talk us through how the trust aims to meet all of these goals, Samantha will talk for around 30 minutes before handing back for 15 minutes of Q&A. Listeners can submit questions through the Q&A function in WebEx, which we will monitor as we go along and put to Samantha at the end. For the best experience with these presentations, we would advise downloading the WebEx app rather than watching in the browser, which will also enable you to view the slides throughout the presentation. Now, without any further ado, Samantha, over to you.
Thank you very much, Ryan, and thank you everyone for joining today. So Murray International is a very well-known trust, but I will take you through the basics and we'll cover things like what the trust is, its investment objective, the breakdown of more recent performance and also longer term performance. I'll look at some changes we've been making to the trust over the past year or so, and then we'll have a look at positioning. So if Ryan, if you could move on to the first slide, please. We begin every single presentation with an explanation of what the investment trust is trying to achieve. And for Murray International, it is fairly simple. So what we're looking to do is to deliver an above average dividend yield, and that's looking at our yield compared to the peer group as assigned in the AIC, and we fall within the equity income category. Now, we also want to grow that dividend and grow that capital ahead of inflation, ideally. And we do that predominantly by investing in global equities, although we do have the ability to go into fixed income as well, which we have done in any size twice in the last 20 years. It's predominantly equities. Now, one differentiating feature of Murray International is that through trying to deliver this above average dividend yield, we seek to generate that income from the underlying holdings income. So we seek to have a covered dividend, which is a bit different from others in our sector. It means that we're not therefore as reliant on markets going up in order to try and achieve that dividend goal. Now, in terms of the track record, you can see on the chart here, the blue line is the dividend yield of Murray International over time. And we have been able to achieve the above average dividend yield fairly consistently, and the level sits roughly between 4 and 5% historically. Just now it's at the lower end of that range because the share price has actually been quite strong. In terms of the other aspects, we have grown the dividend for the past 20 years, so we now have the Dividend Hero badge. And even before that, it wasn't the dividend was cut, it was maintained flat if you're going back 20 odd years ago. In terms of growing the dividend ahead of inflation, we have managed to do that most of the years. So, for example, 15 of the past 20 years, we've managed to grow the dividend above inflation as measured by the UK RPI. And the CAGR on that, the compound annualised growth rate, is 7%. The total return ahead of inflation we've managed to achieve in 14 of the past 20 years. And looking at the very long term, so if you look at the average annualised return over the past 20 years in sterling, that figure comes in at roughly 10%, which isn't hugely different from what you could have got from an equity index like the MSCI or the FTSE All World, for example, but it's done in a very different way. So to start with, around half of that total return is coming from income. And what you tend to find is that there is a degree of downside protection in the trust. So given that we are seeking to have a covered dividend, that leads us away from some of the more higher growth, perhaps more racy areas of the market, which gives us a bit more reliability, if you like, in returns compared to the marketplace in general, so less volatile. And if we look over the page, please, again, some key facts about the trust. And you can see from this that it is a large trust. So that figure actually, even since the end of September, has gone up quite a bit. So we're now at 2 billion in terms of gross assets. The trust has been around for a long, long time, as have many investment companies. So it started off in 1907. And this idea of having a covered dividend and the structure of an investment trust means that we have the ability to put income away, put it aside for a rainy day. And we are in the fortunate position of having very healthy reserves at Murray International. At the half year point this year, we had 78 million sterling in reserves, which means that if you get a year that you can't quite cover the dividend from the income generated from the holdings, that's what the reserves are there for. You can go in and use that to top it up, which we have done on occasion in the COVID years, for example, of 2020 and 2021, we did that. So as well as having, that consistent growth in dividend, we also have that rainy day fund, which has been very useful over some of that period. Now, one thing that strikes you if you look at Murray International, if you can go back, thank you, is that it's pretty different from pretty much any global fund, never mind any income fund that you might want to look at, in the sense that it doesn't have the same kind of exposure to technology. It doesn't have any of the Mag 7, for example. Not that we don't like these companies or think they're good businesses, but when we're trying to have a covered dividend, have a running yield of around 4.5%, the fact that these big companies pay, in some cases, no income or very low levels of income would make that extremely hard to achieve. So we have no exposure to those names because they don't fit the investment mandate. And having said that, we do have some technology exposure, some of which has done very well, but we'll go on to talk about that in a little while. We do have some gearing, as you can see from this slide, 5.6% currently, and the level of that gearing is determined by what we're being asked to pay. And at the moment, it's at the lower end of where it has been historically, because we have come out of that very low interest rate period into a higher world just now. So over the last 2 years, we had paid back some of our debt, just not renewed it essentially, so that we have around 110 million in debt currently. And we'll keep renewing that, keep looking to see what the rates are, but we don't have to have it. So it's got to make sense if we take on any kind of debt. And then on to the next slide, please. This gets into the details now. So in terms of performance, it's been a really strong year for the trust. And the year-to-date figure there in terms of its NAV return to the end of September is 14.2%. That compares to about 8% for a standard equity index, so it's pretty good. And looking at where it's come from, this gets the message across, I think, that it's not about trying to pick regions of the world, it's not about trying to pick sectors even, it's all coming from the stocks. So in Latin America, for example, which was the top contributing category in the first 9 months of the year, we only have 4 positions. The whole portfolio just has 50 stocks in total, 4 of which are in Latin America. About 7% of our net assets, but a couple of these stocks did very, very well over the first 9 months of this year. One of the standouts there was a company in Mexico called Grupo Asur. This is an airport operator, so it runs, amongst other airports, Cancun Airport in Mexico, and it came out with a bumper dividend package for this year, which has been great for this kind of strategy, but it's also been very well received by the market in general. So that category has been strong overall. We've always had a decent exposure to Asian equities, given the income requirement of the trust, and that was another strong category, up 18% up to the end of September. Now, within there, we have quite a number of companies, different types of companies that have performed very well. Something like a TSMC has been a very strong performer, along with other AI names, but also within Asian equities, a stock like Hong Kong Exchange, just operationally has done very, very well. Singtel has done well on the telecommunications side. So different things going on there which have added value. And the most disappointing category from a regional perspective has been UK equities. So the trust doesn't have an awful lot of exposure to the UK, just because we see better opportunities, a bit more diversification elsewhere. But that one was still positive, just under 4%. And within there, we have had contrasting fortunes. So we own British American Tobacco, one of 2 tobacco companies left in the trust, which has been a stellar performer. It was very resilient in the first time of the year. And then we had against that, names like Diageo and Taylor Wimpey being a bit weaker. Taylor Wimpey being the only really domestic focused UK name that we currently own. And then over the page, you will see the same sort of split, but this time by sector. And again, this is where you can see sometimes trends emerging. So I'll start with the bottom this time. So healthcare was a weak sector for the trust, a weak sector for the market in general. And it's been an interesting sector in that it started the year off really pretty well. If you remember, up till, kind of April time, there was a lot of concerns over tariffs. So there was a lot of concerns over the implication that might have on global growth, for example. And these stocks were doing what they should do in a global portfolio and proving to be quite defensive at that time and holding up pretty well. But then as the world kind of shifted from that stance, what we saw was that the tariff question marks were being applied to healthcare. And there were some individual stock issues as well, with some disappointments in trials, etc. So within healthcare, we have names like AbbVie in the US, we have Merck in the US, Sanofi, which is French listed. And it was more kind of sector weakness that dragged these names down. To the point that we've been adding a little bit to them because we think that the share price weakness in some of these names was overdone. Within industrials at the top, we have Grupo Assur, I mentioned previously. We also have names like Siemens, the German conglomerate, which had performed very well. And one of our newer holdings, Kony, the elevator operator, had a strong period. So a number of different positions in there adding to the overall returns that we've seen so far this year. Tech, again, it's been a bit of a rocky ride. You can see we do have exposure there to technology, and we do have some of the stocks which are caught up in the AI excitement at the moment, but it's a smaller weighting than you'll see in many other trusts, largely because of the yields that these companies can provide. They're definitely at the lower end of what we can have in terms of trying to achieve that covered dividend yield. But as always, you'll see quite a lot of dispersion between returns, which is actually what we really like. We don't want to get everything right at the one time, because therefore it's all going to go badly at the one time. So having the global remit that we have has been really quite a powerful thing over time in order to try and smooth out those returns and generate the income that we need to tick off that box in terms of growing the dividend and covering the dividend for our shareholders. So if we can jump on to the next slide, please. This is just really to touch on currency. So we have a very global trust. We are invested in, I think it's 23 different countries at the moment, 19 different currencies. And because it's a sterling-based trust with very little sterling exposure, about 10% overall, what happens on the currency side can sometimes have an impact, both on the capital performance and on the income that's being derived from all these different places. So this was just really to show you a snapshot what's happened in the first 9 months of the year. And this is a fairly typical picture in that some currencies have been weak against sterling. That's the ones in blue at the top. And then other currencies have been a bit stronger, and that's the black ones at the bottom. So the more meaningful ones are the US dollar and the euro in terms of where our exposures are to individual currencies. But what you saw last year was really quite interesting and quite unusual, because most of these bars were blue. So sterling was strong against most currencies, and that had a negative impact on the trust. It meant that the covering of the dividend became tricky because you weren't getting as much when you translated it back into sterling. But that's okay. We kind of take that on the chin, to be honest, because that is not a common occurrence. The last time you had a very one-way picture was back in 2016. It was the other way around there. A lot of Brexit talk made that the reverse. So sterling was weak against a whole basket of other currencies back then. So you know you're going to get a few individual years over the period that you're going to get either it all going for you or all going against you. But the bulk of the time, it's a mixed picture. And the alternative to just accepting this would be to hedge those currencies, which we could do. We looked into it. We actually provided a paper for the board back in June to see what that would look like. And it's a skill that we can do within Aberdeen, but the cost and the complexity aren't worth it when you are investing for the long term, which is what we're all about. So this is where we currently stand. It's not really meaningful one way or the other, but it's something that we do update shareholders on because it's a question that does come up from time to time. If we can move on, please. This is giving you a flavour for what's been going on in the trust. So as I said, we do have a buy and hold approach. We do at the start of every year look at every holding we have and estimate what we think each and every holding is going to deliver from an income perspective. We look at what we think is going to happen on the capital side as well. So we have to balance those two investment objectives, the income and the capital. So the trading is largely done if something is happening that we think, you know what, these stocks are just looking too expensive, or something has happened on the dividend side perhaps that we want to take action on. And you'll see the top slices are names which have performed very well this year. So you'll see a number of the technology holdings in there, for example. Broadcom is a name that we continually take money out. It's up another 10% overnight. And that's great from a capital perspective, but it's meant that the dividend yield in Broadcom is now just 0.6%, which is tiny for us. It's really small. It's the smallest of anything that we own. So that poses some issues for us. We can't have too much in that type of stock with this covered dividend investment objective in mind. But that's a 2.5% position currently. Other names that are similar are TSMC and BE Semiconductor. So still decent weights overall, but we've been trimming those names into that strength. And other areas that have been strong are things like Philip Morris. Enbridge is a Canadian company. It's a pipeline company which has performed very strongly also. Siemens, I mentioned earlier, one of our better performing names within Europe. So what we typically do is take capital out of names which have rallied very strongly and put that to work in things that we still believe in, but which have been lagging. So that is your names like your healthcare stocks. Some of the consumer staple stocks come into that category. We own both Diageo and Pernod, which have been very weak for the last couple of years actually, but we still think these companies, if you're looking at it for 5 years down the line, where they're priced just now, are quite attractive investments. So we've been moving some capital around in that way, which is always what we do. And then in terms of the new purchases and the divestments, there have been some switches, not directly linked to tariff moves, but linked to the volatility that period in early April provided. So for example, we sold out of Banco Bradesco, one of our Brazilian holdings, and put that into the Italian bank Intesa Sanpaolo. So at that point, earlier on in the year, actually emerging markets had held up very well, a bit more removed from the interlinking of trade, etc. And Banco Bradesco had been very strong. The opposite was true of Intesa Sanpaolo. And these two stocks are on a similar dividend yield, about 8%. But trying to predict the Latin American ones can be tricky. From an income perspective, they're not easy ones to forecast. You have a bit more visibility in Intesa Sanpaolo. So in valuation grounds as well, we thought it was a stronger pick at that time. So we don't always have to switch from one category into another, but that was an example where we did in that instance. Some names like Atlas Copco, that's a Swedish company. It does a lot of equipment for mining, etc. That had just been incredibly strong. So we sold out of that one just because the investment case had played out. And then there are instances where we get things wrong and we've just decided to move on. So an example of that would be China Resources Land. This is a company, a logistics and property company in China that we bought about 5 years ago now, knowing that it would be a tricky one. But where we are now isn't much of an improvement from where we were 5 years ago in terms of the property market in China. And it really dances to the tune of what policy is rather than individual companies, even good ones, relatively good ones like this, making their mark and becoming stronger as the weaker players disappear. So that hasn't happened. It might well happen, but we could be waiting another 10 years for that to transpire. So we moved on from that one. And on the purchases side, again, fairly typical at this point in the year to see 6 names in. There's not a hard and fast number that we go by, and it is driven by opportunities. So things like Intesa Sanpaolo, Infosys was similar. So that was an Indian IT stock. It's been growing its dividends really nicely over time. It was bringing a bit more diversification into tech, where we were quite semi-heavy. So this is more IT services. So we like that different kind of exposure, bringing something different. So fairly typical, 13% of gross assets is pretty standard, but it can fluctuate just depending on what opportunities come around and what's happening with the stocks themselves. And if we move on, please, this is a slide which shows the top 10 holdings in the trust as at the end of September. So you'll see here a real range of different businesses coming through. So we've got a tobacco company listed in the US but international in nature. We have a Taiwan Semiconductor. We have Grupo Asur, the Mexican airport operator, a US healthcare company. CME is a US exchange. And then you have Broadcom, another AI name. You have DBS, which is a Singaporean bank. Zurich Insurance is pretty self-explanatory. Enbridge, I mentioned previously, the Canadian pipeline company, and Cisco Systems, which again is a different kind of exposure within IT. And these are pretty big positions. The maximum we would have typically is 5%. The minimum is 1%. As I said previously, 50 stocks at present. And the dividend yield is quite an interesting column. So you can see here that we do operate a barbell approach here. So we want to have the running yield of about 4.5%, but it's not that every single company has to deliver that. So because we have things in here, like an Asur or like a DBS group, for example, with higher dividend yields, that frees up some room to have the likes of Broadcom and still have your generated income enough to deliver a covered dividend typically. And then moving on, please. This is giving you a snapshot of the regional breakdown of the trust and also looking at where all the different sector exposures are. So this is as diverse as it ever has been, and that's fantastic for us as stock pickers when we're trying to just have 50 stocks, ideally that have nothing in common. That's the ideal scenario, but what you can see here is a really good split, and it does change over time. So although I'd say we typically have fairly low turnover, that doesn't mean nothing, of course, and even over the last 5 years this has changed really quite dramatically. So for example, North America is big for us now. 33% is really quite sizable. 5 of that's Canada, so you get roughly 28% in the US. If you roll back, 5 years ago, that was more kind of like mid-20s. So it has come up quite a lot since then, partly performance driven and partly just more companies offering you the kind of levels of income that we're looking for. And European equities is another one that has changed quite a bit over the past 5 years, currently 23%. Going back again to sort of 2020 time, that was more like 14%. And where you saw a jump was, a kind of 2 or 3 years ago when Russia invaded Ukraine. That whole market was very weak, but there were good stocks within there, we believe, that were offering something different in the trust, offering good yields, and were typically global businesses, so not as dependent on what was happening in their listed country. So we introduced at that point names like Siemens and Danone, the French company at that time. So that really led to that weighting going up. Asian equities has come down a little bit because we've freed up room for these other companies. But that's currently, again, quite a sizable part of the trust at 23%. And then UK equities has gone up. So we have seen some opportunities there. We've been adding to things like Diageo. We introduced Taylor Wimpey. Mostly global businesses, really. It's just Taylor Wimpey, as I said, that's the UK domestic name that we have exposure to. And then another category which has been coming down a little bit is Latin American equities. That was about 13% 5 years ago. And again, just driven by partly some of the stocks holding up quite well, and partly, just currencies having an impact over that time. Last year was a time when the Mexican peso and the Brazilian real went against us, so that brought that weighting down a little bit too. And then another category that has changed over time is the emerging market bonds exposure. So I haven't talked about this at all yet, but it is there, fixed income as an option if we're finding it hard to get what we need from equity markets. But over the past few years, we have had plenty of opportunity within the world of equities. So we have been reducing some of these positions or selling them out because we prefer the simplicity of equities. If we're doing anything fixed income based, we work with our colleagues in fixed income to, really rely on them to give us a good steer. We would rather do it in equities where Martin and I, my colleague who run the trust, have the bulk of our experience. But really well mixed, and it's the same on the sector side as well. Lots and lots of different kinds of companies, which is pleasing for us as stock pickers. And then the very final slide, please, just looks at the longer term track record in terms of how the trust has stacked up. So one thing to mention is that we changed the board changed the benchmark at the half year point. So previously it had been the FTSE All World, but given the rising dominance of a lot of the tech names which pay zero or no income, it was becoming more and more inappropriate to use that as a benchmark. So what we did was change it to the MSCI All Country World High Yield Index. So when you look at the reference index line at the bottom there, it'll be a blend of those two. So from the 1st of July, it was the high yield benchmark. Now looking at the year-to-date numbers, both share price and the NAV return are above that reference index. And then looking further out, you can see that historically it's really looked nothing like any global equity index. So we did very well in 2022, for example, when markets were falling, we had better performance, we had resilient performance. And then when markets came back very strongly and AI was really the only story in town, we would lag because we can't really invest in some of these names because of the very low income. But people like the fact it's different. We like the fact it's different. And you have to be very clear, I think, about what you offer people, and then it's up to them whether or not it's for them, whether it's for them up to a point. But in terms of what we do, how we are measured, it's all about just trying to meet that investment objective. So that's delivering an above average dividend yield and growing the income and growing the capital in real terms over time. And I think that's me just about at the halfway mark. So I'll finish there and very happy to take any questions. Thank you.
Thank you very much, Samantha. That was a very interesting presentation, and as expected, we have had a lot of questions come in, so we'll work our way through those. If anyone would like to ask anything more, please go ahead. I'll start off with a couple of questions about the process. If you can give us a bit more detail on sort of who makes the ultimate decisions on buys and sells within the portfolio, and then also some details of the analyst team that support the fund managers in those decisions.
Yes. Absolutely. So in terms of who makes the decisions for this trust, it is myself and my colleague Martin Conahan. So we are both the co-managers of the trust. We took over complete ownership of it in the end of June last year. But before that, we had been working very closely with Bruce Stout, who was the manager of the trust for 20 years. So it's not been a case that we've come in and changed things drastically. We both had a voice long before Bruce retired. But it's Martin and myself that make the decisions. And then how we work, or the people that we work most closely with, are other income managers within Aberdeen. So people like Tom Moore that you'll be speaking with tomorrow potentially, and all the other regional income managers within Aberdeen. It's great for us to chat together and discuss income ideas, particularly because we're global. So we want to have that, debate, and we want to have ideas from various other parts of the world. And then in terms of the analyst base, there are over 100 analysts within Aberdeen who cover the whole world. So we have people located in Boston, we have people located over in Singapore, for example, we have a team in Edinburgh, a team in London. And those people are meeting companies every single day. And what they're tasked with doing is to provide ideas for a range of different products, of which income is one. So we have a constant feed of information, a constant feed of ideas for people who think this, might well be of interest for your particular fund. And that debate happens all the time. So it happens in terms of, we've joined Teams meetings together. We have a heads up if a rating changes. So an analyst could put a buy rating or a hold rating on a stock, a strong buy, for example. So if that changes, we're interested in why, particularly if it's a stock that we own. So that communication is really important. So we have that coverage list coming from the analysts, and then it's up to Martin and myself through chatting with the other income managers to decide exactly what we want to invest in for the trust.
That's great, thank you. And perhaps rolling on from that, are there any you've talked through a geographic split of the portfolio, but are there any constraints in what you can and can't own? Are you withholding to any benchmark allocations?
There are limits, but it's very, very wide for good reasons. So we have conversations with our internal risk people who, will make sure we're within guidelines for things like, maximum 5% on a stock and things like that. But around the sectors, it's extremely wide. I mean, we're never anywhere near it. It's something like 20%. And then on the regional side, it's similar. So especially from moving to this newer benchmark where the US isn't as big, it's still big, it's still like 50%, but it's not 70%. So we don't look as different. So we're better if, in terms of a relative way, if that's how people want to look at it. And that whole move to the new benchmark has made all those conversations on guidelines just so much more appropriate now, because beforehand we were so busy stripping out so much information because we didn't hold the Mag 7 and they really called the shots for an awful long time. So now we don't have those in our new index. We can really drill into, what's worked, what's not worked. Have we missed some opportunities that might have been good for us in terms of being big index weights, for example. But it's really wide in terms of the range, which is exactly what we want. We don't want to have to buy a stock, just because we are, underweight UK or overweight Japan or anything like that. It should really come from the stocks themselves.
Okay. And has that change of benchmark and perhaps change of manager as well had any impact on the turnover of the portfolio?
It hasn't, no. So we appreciated when Martin and I took over that people were used to us. We had already, spoken to an awful lot of shareholders beforehand, so it was well flagged and well managed. But of course, people are going to be watching and waiting and seeing, are you going to come in and the turnover is going to shoot up because, you really feel you haven't been able to make your mark beforehand. So no, so that 13% at this point in the year is really pretty much what it has been on average over many years. And the benchmark change as well, the board were very clear to us that this was not to change anything in terms of the investment objective is exactly the same. So again, it shouldn't be that, you have to sell things or you have to buy things because you're being measured against a different benchmark. It's just a more appropriate thing to measure you against. It's another tool, another thing that's going to throw up ideas potentially. It's going to make your attribution reports a lot more sensible, things like that. But no, it hasn't, triggered any additional trading on the back of that change.
Okay, thank you. We've got one question about the structure of the trust itself. What are the advantages that Murray International has over investing, having this portfolio in an OIC or even in an ETF?
Yeah, no, that's a really good question. To be honest, before I really became more involved in managing this trust, I wasn't really that aware of the different structures because it was more like mutual funds in the US and things like that I had managed before. And I think the huge benefit of this for this particular product is having those reserves. So unlike an OIC, for example, where you pay out all your income, and it could be you have a fantastic year, but then you have a difficult year the next, so your dividend has to be cut. That ability to smooth out your income over time is really important for our shareholders, because that reliability of income is a main reason why people like the trust, why they like this sector as a whole, to be able to have this smoothing. So you don't have the same kind of money in, money out in terms of redemptions, or you're not selling a portfolio if someone wants to sell a share. It is just a company that you'll buy and sell the way you would sell any company. So that's important as well. And that structure, and having gearing can be good at times. The ability to have gearing. We've got a lower gearing level at the moment, and the highest it's been is about 14%. So we're now at 5.5%. But if interest rates become a bit lower again and we're getting some good deals out there and we think markets are going to be stronger than that and we can, boost that, why not take it on? But the structure lends itself quite nicely to making these kinds of choices that you just wouldn't have in other types of funds.
Yeah, interesting. Thank you. That's a slight surprise not to see a global income manager not have a bias towards the UK, which can often be the case. Is there anything that would change your mind on investing in UK equities, in particular with the focus on what's happening tomorrow with the budget?
Yeah, I mean, I think it's quite interesting because people do ask us why we don't own more UK sometimes. But from our point of view, it's doubled in the past, even like 3 years or something, but it's not really been UK stocks. And quite often where we've seen great businesses in the UK over time has been in more the smaller cap regions. So I used to manage global small cap funds going way back. And we also always had a really quite heavy allocation to the UK. But what you aren't seeing from those kind of businesses is the level of income that's required here, and also they can just be too small. So the fact that we have, roughly a 50 stock portfolio, it's a $2 billion trust, pounds trust. So a minimum 1% position is really quite a big company. If you don't want to be trapped in anything, you want to be able to manoeuvre. So where we're seeing sometimes the more interesting UK businesses is more at this kind of smaller end of the market cap scale. That maybe someday will be big enough, but not quite yet. And even, within the UK, I mean, we've held in other products over time, names like AstraZeneca and names like that, but you can just get, I think, sometimes more bang for your buck in an income strategy by going out with the UK, and that's what's maybe held us back from some of these businesses. Although we do own, we own Shell, we own Rio, that are listed in the UK. Sometimes the labels change on them, and again, we don't really care if it's classified as UK or Netherlands or Australia or whatever. So it is all about the businesses, and we keep looking. We get plenty of ideas from our UK analysts, so we're not anti the UK at all, but it is truly global, so it should reflect that.
Interesting, thank you. More questions on the portfolio, which is really encouraging. Emerging market debt continues to be a feature. Why that over some sort of higher yield debt?
Yes, so the reason that we have emerging market debt goes back to when we first bought it, which was 10 years ago. So at that point in time, what we were seeing is that the levels of income and the prices in some of these instruments was like a screaming buy to us. We were seeing things like a Valley corporate bond trading at 60 cents on the dollar. And we already held the equity, so we were happy taking on the risk in the equity. So why would you not consider the bond at that point in time? So it's not that we've not bought any since then, and we've not bought any new ones in the last 10 years, but we've held some of these. And even the likes of that Valley bond, we ended up selling for 140. It's only a par bond, but during the COVID years, it held up very, very well. And we have held treasuries and gilts if you go back even further. If you go back to sort of 2007 times, and we did hold some gilts and some treasuries because we were struggling to get the income that we needed from equities. But then, you roll on a couple of years and you're seeing lots of good equity options on, the income side. So it's just about opportunity. We would never say never, but at the moment, looking at the debt profile, it would kind of make us a bit cautious on some of these investments here right now.
Interesting, thank you. And now looking at sort of the portfolio itself, sort of valuations, as questions come in about sort of the forward price to earnings of the fund, and then sort of the forward yield as well. And then perhaps sort of evolving from that, how do you go about setting out the level of income you're going to pay out from the fund? Is it a predetermined level, or will it just be an output of sort of the income you've had coming in?
Yep, so the forward PE is about 15 times, which is roughly in line with the new index. So again, a lot of these metrics are just a lot more alike the benchmark now than what it used to be. The dividend yield is like 4.5%. That's been growing, I think, about 10%, or on average, if you look at the underlying growth in the dividends of the companies that we're invested in. So we actually are seeing quite nice traction in terms of companies growing their dividends. So again, it's not just about hitting that target 4.5, because you can get plenty of companies that look good, but then they go wrong for all of the reasons that you don't want. You actually want that ability and the willingness to keep the dividends coming through through thick and thin. So that's been a good feature that we've seen over time. And sorry, what was the other part of the question, Ryan?
What determines the level of payout?
Yes, so in terms of what we are seeking to achieve at the start of every year, we will make our own estimates as to what we think all our current holdings are going to deliver in monetary terms over the course of the year. So we know what we need to get a covered dividend, and we want to grow that dividend. So we'll have some sort of scenarios, but it's a board decision in terms of what the level is. And with our input, like we will absolutely keep the board updated. We've got a board meeting next Wednesday, so we'll give them an update of what we know is banked this year already, what we think is going to come for the rest of the year. And then, that decision will be taken from that point in time as to what the level is going to be going forward. One disappointment for us as managers has been that we haven't managed to grow the dividend ahead of inflation for a couple of years now. And that's partly to do with just the levels of inflation. We had double digits some, not that long ago. So that's a big ask. And you're also coming off the back of a period where a lot of companies were just pulling back their dividends, coming out of COVID. There was a very little visibility. So you had some caution on that side as well. But it is one of the KPIs of the trust. It's been really pretty meagre, the growth. We have achieved it, but it's been at the lower end of what I would like it to be. But we'll see. We'll have that conversation, in due course with the board. But personally, I would like to be able to grow it a bit more if possible.
Thank you. And I think that last question kind of answers this question, but what level would it be for some of the AI companies that have driven the market to get into the portfolio? Do you have a minimum yield? Is there anything in them that you think, well, those growth characteristics would really help, but we're out of yield? So
it's a good question. So the smallest yielder we have just now is Broadcom, which is 0.6% dividend yield. And from a capital perspective, okay, it's not one of the headline AI names, but it's been so strong. I mean, it's up 65% in sterling year to date. It doubled the year before. It doubled the year before that. So we've taken so much money out of that name, or it would have been about 20% of the portfolio. So we've taken a lot of money out of it, and we do agonise as to whether we should still hold on to that one or not, because people can get AI from anywhere these days. They can buy the stocks directly, they can buy a tracker, they can buy pretty much any global fund, and you'll get a lot of exposure there. We do offer something different. And interestingly, when we bought Broadcom, we bought it about 5 years ago now. That was yielding 7% when we bought it. So we didn't buy it really because we thought this capital was going to come. We really got lucky on the AI side. So it's a different investment case now from what it was when we bought it. So would we introduce another 0.6% yielder now? No, we wouldn't. So anything we're looking at just now has, say, a minimum of like 2% dividend yield, and with the idea that that's going to grow over time. But we do have a couple. We have Broadcom, we have TSMC that are below that level currently. But that's why we've been taking a lot of money out of these names, because maintaining and growing that dividend is really important.
Perfect. Thank you very much. I've got two slightly esoteric questions now, hopefully quite quick fire. One of them is about Saba, one of our favourite topics, I think, in the office. Has that been a feature for the trust at all? And if so,
it's not been something that's given us any issues at all. As you can imagine, people have been scouring through the share register to see if there's anything lurking there that perhaps isn't obvious. And that there hasn't been. I don't know if the discount never really got wide enough to get them interested, because I think even when it was wide by our standards, I think we recently got to like minus 12% back in January of this time. At that time, there was other trusts on, much wider discounts, and then it's come back and, it's about 4% currently. But you can't be complacent about these things. You do have to make sure you know who your shareholder base is, and we go out and talk to them all. So it's something that is still at the forefront of the board's mind, just to make sure nothing catches us unawares.
Yep. Thank you. And then the very last one, just before we wrap up, we're close to time now, is what's the level of manager ownership of the trust?
Yeah, so we do have a stake in it, Martin and I do. We don't disclose what it is, because, to be honest, with throwing out a number doesn't tell you much unless you were going to go through what all our other investments are, what our other commitments are, but it's something we're very happy to do, and we've held this for a long time as well ourselves personally. So nice to see it, that discount coming in, nice to see it doing well. And it's the only thing we manage now. Martin and I have managed various things over the years, but this is our baby. This is what we do day in, day out. So we're very much aligned with the product.
Well, on that very positive note, we will draw proceedings to a close. So Samantha, thank you very much for your time. We really appreciate it. Thank you to all of our listeners and watchers as well. All the slides and a replay will be available in the coming days on the KTI website, with a summary of all the presentations will be coming out next week. Furthermore, you are able to visit the Murray International website for further details, and then also make sure you are signed up for the rest of our presentations later in the week. Just leaves me to say thank you again, Samantha, and goodbye and have a good afternoon.
Thank you very much. Bye-bye.